In this video, I'm going to continue my discussion of risk and return. We ended last time talking about the benefits of diversification. Now, we'll start by explaining how we use the type of risk we can't diversify away. Next, I'll introduce the security market line, and then finally we will discuss the capital asset pricing model and talk about how to calculate it. Let's start by reviewing what we covered in the last video. Total risk is measured using standard deviation. It can be broken up into systematic and firm-specific risk. Systematic risk is the risk that every stock is exposed to, while firm-specific risk is the risk that only one firm is exposed to. Now, if we have a completely diversified portfolio, the only risk left in our portfolio will be that systematic risk. Now, because you can build a portfolio that completely diversifies away firm-specific risk, the only risk that investors should be compensated for is systematic risk. This is the basis behind the systematic risk principle, that reward for bearing risk depends only on the systematic risk of the investment. Now, you might be wondering how we calculate systematic risk for individual securities. The short answer is that we regress the historical excess returns of a security on the historical excess returns on the market. The coefficient on the excess return on the market is referred to as beta. We indicate beta by using the Greek letter, obviously, beta. The higher the beta, the higher the amount of systematic risk of a stock. Now, I'll go over to Excel to show you how to calculate this beta. Just as a side note, I will not ask you how to calculate beta on the exam, but you should absolutely understand what beta is and how it's used and why it's so important. So I'll head over to Excel and let's go through this. So I'm going to use the example of beta tab in our Excel spreadsheet. And I mentioned regressing something on something else. And when we regress one variable on another variable, essentially what we're doing is using a simple or a multivariate OLS regression model. I'm using simple linear regression. So I'm going to regress the stock in question, its excess return, on the S&P 500 excess return. And an excess return is just the difference between a raw return, just a return over a period, say 1 month, as in this case. So this is Apple's 1 month return in this period, and we subtract the risk-free rate, which in this case is just a 1 month T-bill, or the rate on the 1 month T-bill. The S&P 500 excess return is just the difference between the return on the S&P 500 in a given month and the risk-free rate in a given month. So all I'm going to do is go up to the Data tab, and since I've already got the Data Analysis tool installed on my computer, I'm going to click Data Analysis, go down to Regression, click OK, and my Y range is going to be Apple's excess return. My X range is going to be, obviously, the S&P 500 excess return. And because I have labels in the first row, so row 1, I'm going to click Labels, and I'm going to output that right here, right next to what I already have. And that's that. And I'm going to click OK, and now you can see that I have some output. So I just ran a simple OLS regression, and here's my results. So we have an intercept of 0.00265, or 266, rounding. And down here we have a 1.21 coefficient on our excess return on the S&P 500. This coefficient, this one cell, this is our beta. This is the beta that I'm going to mention throughout the remainder of this video. We can calculate it a couple of different ways. Sometimes we use daily returns, sometimes we use monthly returns, sometimes we use something else, sometimes we use all kinds of other measures. Right now I believe I'm using 60 months of observations. Some people prefer to use more, some people prefer to use less to calculate the beta, but there it is. There's me and how I calculated this beta for Apple's stock. Now, let's go back to our PowerPoint video. So now you kind of have a sense, or hopefully have a sense, of what I'm doing to get beta. And you can always look up beta in Yahoo Finance, and I'll show you how to do that later in this video. All right, now the beta we just calculated is formally calculated as the covariance between an excess return on a stock and the excess return on the market. And so you undoubtedly calculated covariance in your basic stats class. Now, as you saw from the example I just showed you, we often use the excess return on the S&P 500 as the excess return on the market. The reason for this I'll get into a little later, but let's talk more about beta now. Now, what indicates a high or a low beta? Well, let's talk about what indicates an average beta first. So a beta of 1 indicates that a stock has average systematic risk. In other words, that stock has the same level of systematic risk as the overall market. The reason we say that is because if you regress the excess return on the market on itself, you're going to get a beta of 1. Now, a beta of greater than 1 indicates that a stock is riskier than the market as a whole. A beta of less than 1 indicates that the stock is less risky than average. Most stocks are going to have a beta between 0.5 and 1.5, but it is possible that you can actually have an asset that has a negative beta, meaning that when the market has a very low return, the asset will have a high return, and when the market, aka the S&P 500, has a really high return, this asset will have a very low return. The classic example is gold. So gold miners are known for having a negative beta. The reason for this is that the price of gold typically spikes when there's a financial crisis or when investors have very low confidence in the US economy. And so we see this negative relationship between returns on gold miner ETFs and stocks of gold historically and the S&P 500 return. So typically these stocks do really well in poor market conditions. Now, let's get a sense of the betas of some well-known stocks. So I pulled this data a long time ago, but it kind of illustrates what we have going on here. So we have a couple of ETFs, and notice here I mentioned a gold trust ETF, or I mentioned gold miners actually have occasionally negative ETFs. As of right now, because we're using historical data, the beta on this particular ETF, which holds a number of gold miners, is actually slightly positive. In certain markets, we would see this go negative. Now, Walmart is an interesting case. So Walmart has a beta of 0.2, which is obviously less than 1. So in other words, the beta on Walmart indicates that Walmart has less systematic risk than the market as a whole. And you might be wondering why this is. Well, the answer is because Walmart, primarily they're selling goods that are always going to be needed. I mean, Walmart, the super Walmarts sell food. Everyone is always going to be buying food. I mean, in a financial crisis, people are still going to need to go to the grocery store. They sell goods that are, as we say, inelastic. So Walmart, in the case of a financial crisis, is not going to be affected nearly as much as, say, a company that sees its sales drop off in the case of a financial crisis, like GM, General Motors, which produces cars. In the case of a financial crisis, Walmart's sales revenue is still going to be fairly high. They might see people stop buying some of the ancillary goods that are sold, but they're not going to suffer as much. They have less systematic risk. They have less exposure to those big market events that affect every company. They're still going to be affected, but not by much. Now, Citigroup, General Motors, Apple, they have betas of greater than 1 as of when I pulled this data and calculated the beta. But, I mean, the higher the beta, typically we say the higher the expected return, and I'll talk about why that is in a second. But these companies, they do really well in bull markets, and they do really bad in bear markets or financial crises or any downturns in the market. Now, let's talk about the relationship between standard deviation and beta using a very quick example. In this example, I have Apple and Google, and I have their standard deviations and their betas. And let's talk about which security has more total risk, more systematic risk, and which one should have the higher expected return. Well, remember that our measure of total risk of a given stock is always going to be standard deviation. So in this case, Google has more total risk than Apple, based on their standard deviations. However, Apple has a higher beta, which means that it has more systematic risk. If there's, let's say, an asteroid that hits the eastern coast of the United States, Apple's going to be more heavily affected than Google might be. Now, which security should have the higher expected return? Well, remember what I mentioned a couple of minutes ago. The only risk that should be priced by investors is systematic risk, which is calculated using beta. And the reason for this is because you can diversify away the rest of the firm's risk, meaning that firm-specific risk, that risk that only Apple might face or only Google might face. So in this example, we would expect Apple, based on the model I'm about to show you in a few minutes, to have a higher expected return than Google. Now, there are some important characteristics of beta, but there's none more important than the fact that you can calculate the portfolio beta as the weighted beta of a set of assets. The formula for portfolio beta is a weighted average formula, similar to that of the expected return formula. So all we're doing is just multiplying the weight of each asset times the beta of each asset, and then summing up those weights times betas. So let's take a look at an example. In an example like this, we have essentially the same problem that we did earlier. We know Apple's standard deviation and Apple's beta, and same thing with Google. And we know that we currently have $6,000 in Apple stock and $4,000 in Google stock. What is the portfolio beta? Well, to answer this question, I'm actually going to go over to Excel and work this problem. All right, so here's our data. And to make things easier, I'm going to just get rid of these first off. And then I'm also going to put in our values of Apple stock in our portfolio. So we'll say value invested, and we have $6,000 in Apple stock and $4,000 in Google stock for a total of $10,000. All right, now to get our weights for this portfolio, all I'm going to do is just take the value we have invested in Apple, and maybe I should just put Apple over here and Google over here. What I'm going to do is I'm going to take the amount we have invested in Apple and divide that by the total value of our portfolio, and that gives us a portfolio weight for Apple of 60%. I'm going to do the same thing for Google, and obviously the weight that we have in Google in our portfolio is going to be 40%. Now, that's that. Let's calculate our portfolio beta. The way we're going to do that is we're going to multiply the weight times the beta for each of these two stocks, and then we're going to sum it up. And here we find that our portfolio beta is equal to 1.14. So this portfolio is slightly more risky than the S&P 500, so the market as a whole. And if we wanted to predict the return on our portfolio, we'd be using this beta, this portfolio beta that we just calculated. So now I'm going to jump back over to our PowerPoint slides. Now let's talk about the S&P 500, because this is what we often think of when we think of the market in the United States. The S&P 500 is a valuated index of 500 large cap stocks in the US. Valuated means that the stocks are weighted based on the percentage of the total market cap represented by each stock in the S&P 500. So Apple, Google, Amazon, those large tech companies are going to have larger weights in the portfolio than, let's say, a company like Caterpillar, or a smaller company, or a company that has a smaller market cap than our large tech companies. Now, we use the S&P 500 index because it accounts for approximately 90% of the total market cap of all listed stocks in the United States. Now let's take a look at the beta of the S&P 500. And I'm going to pull the data, or the beta of the S&P 500 right now. And I'm going to do that by going to Yahoo Finance. And I've already provided the link. So click the link. All right, so Yahoo Finance is one of our best locations for finding data on stocks and a lot of other assets. So here we have the S&P 500 index, and I want to know some summary information about the S&P 500. So we have this. We know what the S&P 500 has done in terms of returns or index value. We can see its components over here. Apparently not. But let's take a look at an ETF that holds all of the stocks in the same weight as the S&P 500. So I'll go to the SPDR, as it's sometimes known. The SPY is the ticker symbol. The S&P 500 ETF. It's one of the largest ETFs in the world in terms of total funds invested. And so what we have here is just an exchange-traded fund that holds a portfolio of stocks in roughly the same weights as they exist in the S&P 500 index. And I can pull all kinds of different data on the SPDR, but the one I'm really focused on here is its beta. So I mentioned a few moments ago that the beta of the market is 1. Well, here it is in the real world. Our beta of the S&P 500, as of right now, using 3 years of monthly data, so 36 observations in their regressions, yields a beta of 1. So that's pretty much it. That's what I wanted to show you. If you ever wanted to look up the beta of a company, just go to Yahoo Finance and look it up directly on the summary page of whatever asset you're looking up, usually a stock. All right, now let's talk about something that I'm sure a lot of you watching this are fairly interested in. How do we predict returns? Well, before I start, I should say there are several ways to calculate expected returns, some of which I've already mentioned in these videos. However, the method I'm about to show you is one of the most important and most commonly used methods in the real world for predicting expected returns on stocks and other assets. Now, we'll start off our discussion of predicting returns with an explanation of the risk premium. A risk premium is the excess return of a risky asset over a risk-free rate. In other words, we take the return on an asset and subtract the return of some other asset, usually a US Treasury bill that's viewed as having no risk. Now, the excess return on the S&P 500 is historically about 6%, while the excess return on long-term government bonds is about 2.5%. Obviously, the excess return on a US T-bill would be 0. If the T-bill is our risk-free rate, obviously, when we subtract it from itself, obviously we get 0. Now, notice that the average rate on the US T-bill over the last several decades has been about 3.6%. This is actually a bit higher than the current rate. The reason for this is that inflation has historically been higher than over the period of about 1930 to about 1990, or maybe a little past that. So that inflation rate over that period was historically higher than it has been for the last 20 years. Now, as the inflation rate increases, typically the risk-free rate has to increase to compensate investors who are lending their money to, let's say, a company that's issued bonds. Otherwise, if let's say the risk-free rate was fairly low, or let's say the interest rate on, say, bonds were fairly low, no one would invest because their return on investment would be eaten up by inflation. So typically, the yield on the US T-bill is slightly higher than the actual inflation rate in a given period. So for example, right now the yield on the 1-year T-bill is about 2.5%. The inflation rate in the US is right now about 2%. So you can get a sense that, yes, you can invest in a US T-bill, a 1-year T-bill, and you're getting 2.5%, but you also have to take into account inflation, and after that, your yield, or the actual growth in your money over that period, is actually way less than 1%. Now, the risk-free rate is important to investors because it represents the return an investor can earn on an asset that is riskless. Investors often use a US government treasury like the 3-month T-bill, or I just mentioned the 1-year T-bill. Sometimes they'll also use the 10-year T-note if they're trying to value a company and they need a discount rate called the weighted average cost of capital, which we'll talk about later on in these videos. Now, to view the daily rates for these T-bills and T-notes and T-bonds, just go ahead and click this link, and I'll leave the link in the description of this video below. Finally, the expected return on a stock incorporates a stock's beta. Remember, investors need to be compensated for systematic risk, and the best measure of systematic risk is beta. The higher the beta, the higher the expected stock return. Now, we've talked about the risk premium, the risk-free rate, and the beta. Now let's put all three of these components together and talk about the security market line. All right, so what is the security market line? Well, the security market line is a graphical representation of the relationship between beta and the expected return on a given stock. So I've given you the formula here. It essentially says the expected return on stock I is equal to the risk-free rate, RF, plus the quantity of the expected return on the market minus the risk-free rate times the beta of stock I. Now, if we plot this graphically, what you're going to see is this. So we have the expected return on stock I, or expected return on I, on our y-axis, and the beta on the x-axis. And as you can see, we start off with the risk-free rate. The risk-free rate is the rate you get if you are just interested in investing in a US T-bill. So if you don't want to take a beta, or you don't want to invest in a stock, you're going to get some return, but that return is going to be the yield on the 1-year T-bill, which is really quite pitiful if you're a younger investor trying to grow your portfolio. Now, as you increase the beta, the expected stock return based on this model is going to grow linearly. And so the higher the beta of your portfolio or stock or whatever is, the higher the expected return on your portfolio is going to be. And this relationship, which is given in this formula, this is what's sometimes referred to, or I guess I should say always referred to, as the capital asset pricing model. Now, notice here that let's talk about a couple of different parts of the capital asset pricing model, which sometimes is referred to in passing as the CAPM, just the acronym. So the capital asset pricing model is this model that says you can calculate the expected return on a stock, say stock I, if you know the risk-free rate, the beta, and then the risk premium. So this entire quantity is our risk premium on the market, just the amount by which the S&P 500 outperforms the risk-free rate, or the yield on a T-bill, or if you prefer, a T-bond. Some people use different measures. Now, a couple of facts about the capital asset pricing model. This is the gold standard for calculating expected stock returns. It's been around since the late 1960s, and while there are certainly problems with it, this is often the model we use to predict stock returns. If we need, let's say, to input an expected return in a model, let's say a discounted cash flows model, this is often going to be the model that we're going to use. If we want to, let's say, discount a cash flow for a stock, basically what we're going to do is we're going to calculate the expected return on that stock using this model, and then use that as our discount rate, or one of our components in the discount rate. Now, because this model has been around for at least 60 years, there are many forms of this model and many ways to measure the inputs of each of those components. I already mentioned the fact that Yahoo Finance uses 3 years of monthly data to calculate their beta, but a lot of people use 5 years of monthly data. There are also other models that will actually add factors beyond just the beta to their model when they predict stock returns. Now, let's take a look at an example where we actually predict stock returns using the CAPM, or capital asset pricing model. So consider an asset with a beta of 1.2, a risk-free rate of 1%, and a market return of 9%. What's the expected return on the model? Well, here's our model right here. Our risk-free rate is 1%. Our beta is given as 1.2%, and we just multiply that beta by the market risk premium, which is our 9% market return, or the return on the S&P 500, minus the risk-free rate. And so our expected return on stock I is 10.6%. It will almost certainly not be 10.6% in reality, but this is based on the capital asset pricing model. This is our expected return. Now, let's look at an example where the answer is not already provided. Now, to do this, I'm going to move over to Excel. But let's talk about this model or this example first. So you're considering purchasing shares of Ford. You know that Ford has a beta of 1.28, and the average historical risk premium for stocks over the last 80 years has been 6%. The US government is currently selling 10-year T-bonds, which have yields of 1.67% annually. What should be your required return for this stock? All right, so a couple of things to unpack here. Because we're forecasting returns here, we don't actually know what the market risk premium is going to be over the next year. So a lot of times what we'll do is we'll just assume that the market risk premium, the difference between the expected return on the market and the risk-free rate, we're going to assume that that's 6%. Some people prefer to use 6.5%. It's kind of a preferential thing. Also, we're using the T-bond rate as our risk-free rate. Different investors will use different measures for the risk-free rate. I personally prefer to use the 1-year T-bill or even the 1-month T-bill in some circumstances. Other people might say that you need to use the 10-year T-bill, the 10-year T-note, or the 30-year T-bond. So I mentioned the 10-year T-bonds; those don't exist. 10-year Treasuries are actually T-notes. All right, but let's go through this in Excel. So we know the information that we need. Our beta is going to be 1.28. Our market risk premium is 0.06. And the yield on the 10-year T-note, not the T-bond, is our risk-free rate. And that's 0.0167. Put it in the right cell. And our expected return is going to be equal to 1.67% plus the quantity of 6% times beta. Now, before I hit enter here, I want to point out something. So notice that I didn't take the market risk premium minus the risk-free rate. The reason for this is because the market risk premium, that's the entire quantity of the expected return on the market minus the risk-free rate. That entire thing is 6%, or historically has been 6%. So all we're doing to calculate the expected return using the CAPM is just taking risk-free rate plus the quantity of market risk premium multiplied by our beta. And what we find is the expected return on this stock is 9.35%. Easy enough. Now, let's wrap up by talking about how we actually calculate the CAPM in the real world, using real-world data. So to do this, I thought it might be cool to use an actual stock and actually calculate the expected return on this stock using the model I just introduced, the CAPM, the capital asset pricing model. Now, to do this, we're going to need 3 inputs. We're going to need the risk-free rate, the risk premium, and the beta. Now, we can get the risk-free rate using the link I provided a couple of slides ago, and that's exactly what I'm going to do, but let's talk about the risk premium first. I mentioned in the last example that the historical risk premium was 6%. When you're calculating the expected return on a stock, this is one assumption that you have to make. What is the risk premium going to be? What is the expected return on the S&P 500 or the market beyond the risk-free rate? A lot of people will typically say just input 6% here because that's what it's been historically on average. So for this example, I'm just going to plug in 6% as our risk premium, and then we'll calculate the risk-free rate and the beta. So let's get our risk-free rate. So what I'm going to do is I'm going to go over, or rather back a couple of slides, and click on the link to the Treasury's website, where they record the daily yields on different Treasury securities. So today is February 21st, 2019, and we have the yields on US Treasuries. So the 1-month Treasury, the 2-month, 6-month, all the way up to the 30-year T-bond. I'm going to go ahead and use the yield on the 1-year T-bill, so 2.55%. And I'm going to put this in a new cell. So 0.0255. Next, we have the risk premium. And I'm just setting that to 6%. Finally, we need the beta on GE, or General Electric. Now, to get that, I'm going to need to either collect that data, that historical data, and run that regression model that I showed you a few slides ago. It's been a few minutes ago. Or I can just go ahead and look it up on a website like Yahoo Finance or Bloomberg. Simply because it's easier, I'm just going to go ahead and look up GE's beta. So I'm going to go over to Yahoo Finance, and I'm going to search for GE, so General Electric, and it'll come up. So we have GE's information, and we should have their beta by going over to Statistics. And I'm going to search for beta because I, for some reason, wasn't able to find it just by eyeballing it. So their beta using 3 years of monthly data is 0.98. So this stock has systematic risk very comparable to that of the overall market, which makes sense given that GE is a very well-diversified company. I mean, they're in a lot of different sectors, so it makes sense that their level of systematic risk is fairly comparable to the level of systematic risk on the S&P 500. So I'm going to take this 0.98 and put it into our model. Now let's calculate the expected return and spell it correctly. So we're going to take the risk-free rate and add to that the product of the risk premium times the beta. And there we go. Using the CAPM, the expected return on GE stock over the next year is 8.43%. Now, certainly the actual return is going to be different from this, but this is one of the most common models we use. I mean, it's certainly the most common model we use to predict expected returns, and this is, if we were, let's say, using a discounted cash flows model and looking for a discount rate, we'd either use this as our discount rate, or we would, if let's say we're calculating something called the weighted average cost of capital, we might use this as our cost of equity, or our cost of the company's common stock, in other words, to calculate the weighted average cost of capital of the firm. But that's pretty much that. So let's go ahead and wrap up. So let's talk about what we talked about, or rather summarize what we talked about. So first, we showed how diversification can reduce risk. Next, we showed that there is a well-known positive relationship between risk and return. And finally, we introduced the capital asset pricing model as a model for predicting expected returns. So that's it. If you do have any questions about the material I've discussed, please feel free to contact me either by email or calling me, or you can stop by my office hours. And that's that. Have a good day.